Good morning. You are watching a live market outlook for Monday, 9th of January 2012. Highlights of today's overnight session are as follows. The euro is down and hits 16-month low during the Asian session and hits fresh 11-year low versus the yen on increased fears of further extension of the Eurozone crisis. Aussie dollar also lower and no help from actually flat retail sales released during the night. A short covering of euro dollar is seen this morning after at late hours of Asian session and early hours of Europe, but for now seem corrective as the broader picture still shows the pair in the firm downtrend. Merkel and Sarkozy to meet today again to seek for growth and new jobs for the Eurozone, as also the German November exports came out better than expected, and this is one of the brighter signals today from the Eurozone. Stronger dollar also supported by Friday's non-farm payrolls that came in better than expected. Release continues to travel higher and pushing the commodities lower again, especially the crude oil and the gold. Brief look to the markets. The euro sank against the dollar and the yen during the Asian session, as well as Asian session were lower as renewed worries about the fallout from the European sovereign debt crisis overshadowed the signs of improvement in the U.S. economy. The rising dollar dragged on commodity prices, with oil, gold all falling, while mixed signals on the global economy kept Asian credit markets subdued for now. The Friday's non-farm payrolls data showed that while U.S. employment growth accelerated last month, Eurozone retail sales fell and the economic sentiment soured at the end of 2011, pointing to recession in the currency bloc. Today's meeting of German and French leaders will be where they will be discussing ways to boost the growth in Eurozone states struggling to overcome the sovereign debt crisis and rising unemployment, and finalize a deal to increase the fiscal coordination within the currency union. They may also discuss financial transaction tax being promoted by France, but for now resisted by Great Britain, unless adopted on a global scale, which could split the European Union at the summit at the end of the month. Chancellor Merkel and President Sarkozy are aiming to align the two powerhouse partners that have driven European integration, will also focus on how to boost employment in the current era of austerity. While Germany's labor market is thriving, employment is a pressing issue for Sarkozy, who faces an election in less than 4 months and is trailing in polls, while French jobless claims are at their highest level in 12 years. He also might try to accelerate plans for a tax on financial transactions, which he has set out as a priority ahead of the election, and which on Friday he vowed to implement in France, even if EU partners like Germany are not on board. Paris and Berlin want a so-called Tobin tax to be applied across the Eurozone, but UK is resisting, fearing it will damage London, a global financial center and mainstay of the British economy, where much of the tax would be raised. On Sunday, the British Prime Minister David Cameron said he would veto a European-wide financial transaction tax unless it was imposed globally, deepening the confrontation over the matter with both France and Germany. German officials expected the EU summit to show satisfying results on stronger budgetary rules that have urged for countries using the euro. The updated version of the EU's fiscal compact, which gives Brussels the right to take states to court if they violate stricter rules, is nearing approval, relieving pressure on Merkel to take new initiatives at the summit. A brief look to today's calendar. As mentioned already, German trade balance came out in better than expected figures. 15.1 billion euros surplus was showed on today's release, compared to 12.3 billion surplus forecasted and 12.5 billion surplus of the previous result. Unemployment rate in Switzerland came actually before the German trade balance. As expected, raised to 3.1% compared to 3% the previous month release. Australian retail sales came flat versus the 0.4% expectation and the previous release at 0.2%. Still to come, Swiss retail sales, actually they are already out. We still don't have the release. And German, actually European Centix investor confidence due at 9:30 GMT. Expectations for today is minus 23.8. Slightly better than minus 24 the previous release, while German industrial production is due at 11 GMT, and the forecast is negative for today, minus 0.5 compared to 0.8% the previous month release. Across the ocean, Canadian building permits are due at 13:30 GMT. Negative forecast for today, minus 3.1 drop is expected, compared to the raise of 11.9% of the previous month. U.S. consumer credit is due late today at 21:00 GMT, and forecast is today is 7.2 billion compared to 7.6 billion US dollars the previous month release. Now let's take a look on the charts and see the latest movements in the markets. As we can see, the euro is in the firm downtrend from the latest lower top at 130.71 posted on 4th of January, and the fresh 16-month low was hit during the Asian session at 126.65. Oversold hourly conditions triggered the current bounce, with break of the near-term bear trend line and regain of break above 20 days simple moving average on the hourly chart, extending gains so far to 127.57. However, the strong barrier comes above 128. First initial barrier is at 128.11, which is the high of 6th of January, last Friday, and then also near here is the 38.2 Fibonacci retracement at 128.19, while stronger barriers come at 128.67, 50% Fibonacci retracement of 130.71 to 126.65, and the low of 4th of January at 128.96. However, the gains are so far expected to be capped above 128 to resume the below 128, pardon, to resume the broader downtrend. However, further extension higher is not ruled out at this point, but 129 level is for now out of reach on euro dollar. On the daily outlook, we can see that bears are firmly in play, but RSI touching the oversold zone might see some stronger correction. Broken channel trend line, bear trend line at 128.48 currently at 128.38 now offers initial resistance with 128.57 low of 29th of December, and the 20 days moving average on daily chart at 129.71. Basically lift above 130 and 130.75 high of 2012, the fresh high of the year. would provide some relief for euro-dollar. Otherwise, the risk remains on the downside, with the test of next strong supports at 126 and 125.86 seen after the near-term corrective action. 126 is approximately 76.4 Fibonacci retracement of the uptrend from 2010 low at 118.75 to 2011 high at 149.38, with the 125.86 low of 22nd of August 2010 seen along with the 126.00. A break of below these levels would signal further weakness of the pair and possibly attract level at 118.75, which is the low of 2010, posted 6th of June 2010. However, meantime, we have some other levels to watch. 124.55 is the low of 2009 and the low of 2008 at 123.31, which are not far from here, and the extension of this downtrend would be first focusing these levels ahead of final push towards 118.75, which is quite likely at this point, as the euro-dollar technically and fundamentally, since still no firm decision and the steps to improve the current situation are pushing the single currency lower. Cable extended again to the downside after hitting a fresh high at 156.68, where actually the gains were capped. This was on 4th of January, testing again a broader range lows. Low of tonight's session was 153.74, just ahead of 153.60, which is 29th of December low and the range floor. And holding above here, it still keeps the pair within this range of 153.60 and on the upside 157.73. On the hourly chart, we can see that the pair is currently in the near-term corrective mode, with break above 20 days moving average, now extending towards looking for test of initial barriers at 154.66.75, lows of 6th and 5th of January, close to which is also 38.2 Fibonacci retracement at 154.86. To ease the current bear pressure and signal the pair back to the range, we need to see a gain of 155.20 zone, where is also 50% Fibonacci retracement, and the bear trend line currently at 155.47. That would keep the downside temporarily out of reach and keep the pair within the broader range. Otherwise, loss of 153.74, 60 lows would attract next levels at 153.26 and 152.71, which is the low of 2011. Also on the broader picture, we have the series of supports at 152.95, 153.43. So basically, loss of these levels would be quite bearish for the British pound. For now, the 90 days moving average on the daily chart currently at 157 caps. The 55 days moving average caps the upside for now and keeps the near-term range highs at 57.70 zone out of reach, with the focus still at the downside. The dollar-yen again is losing traction after dipping to 76.59, just ahead of our strong support at 76.56 low of 18th of November 2011, and the risk remains at the downside as 90 days moving average on the daily chart caps the recovery attempts. As I mentioned, the risk of test of 76.50 still exists, and a break here to open way towards 76.00 and possibly to test the levels, the pre-intervention levels of end of October at 76.56 to avert immediate downside risk, regain of minimum 77.32, which is the high of last Friday, and 50% Fibonacci retracement at 77.40 is required, with lift above 77.55.60 to confirm the near-term bottoming at 76.59 and open way towards previous highs at 78.00 and 78.21 high of 23rd of December. The dollar Swiss confirmed its broader bullish stance after breaking above previous high of 95.45 posted on 15th of December, looking for extension of the broader uptrend from and 70.67, which is the historical low of dollar Swiss posted on 9th of August 2011. Since then, the pair is in the steady uptrend. The latest break above 95.45 confirmed the end of the near-term, short-term corrective phase that was supported at 92.42 and 93.00. With the levels to watch at 97.00 and 97.73, 97.43 highs of February 2011, ahead of a 97.82 high of 2011, posted on 9th of January. Corrective pullback is currently underway as the pair tests levels towards 95.00, which is our initial support, ahead of 94.81, which is the 38.2% Fibonacci retracement of the uptrend from 93.03 to 95.93. Also where 4 hours charts 20 days moving average stands for now, and basically is expected to contain the corrective dips before the bulls reassert for fresh push higher. Clearance of 96.00, our initial barrier, is required to resume higher, and then we have 97.00 as the figure resistance, ahead of the levels that I mentioned previously, 97.73 and 97.82 high of 2011. A brief look at the commodities. The gold is near term again in recovery mode after hitting overnight's low at 1604, with 1600 zone now acting as initial support on the short term. However, the break above 1630 previous high is required to, and 1641, which is the high of 21st of December, also close to 50% Fibonacci retracement of the broader downtrend from 1762.90 down to 1522 to spark a stronger recovery, while holding below 16.42. The focus remains at the downside as the yellow metal is still capped by 200 days moving average, and the extension below the previous low at 1532 pardon, has posted a fresh low at 1522.45 on 29th of December. So for now we are looking for a test of our key short-term barrier at 1642, above which we would see some stronger recovery. Otherwise, this might be signaling a double top and a fresh extension below initial support at 1600, and possible test of 1532 and 1522. Crude oil also is in the corrective mode after hitting a fresh high at 103.72 on 5th of January, so last Thursday, exceeding the previous high at 103.35. The overall trend on the daily chart remains firmly bullish, with the broken trend line now broken bear trend line from 114.80 record high of 1st of May 2011, now offering initial support ahead of 20 days moving average on the daily chart, pardon, at 99 zone, and the higher low at 98.28 that are expected for now to contain dips. On upside, the clearance of 103.35 opens the next level at 104.56 with possibility of extending towards 114.80 quite likely, as the situation, current situation with Iran is not very promising, and the possibility of closing the Hormuz passage for the oil is quite high at this point. That might for sure affect the oil prices.